Hello, this is Veena Murthy, and this is PwC's Tax Insights in Brief. Treasury and IRS just released proposed regs under Section 162M. Section 162M limits the compensation deduction of a publicly held corporation to $1 million for each covered employee in the tax year when the deduction would otherwise apply. In 2017, tax reform significantly expanded 162M's reach, amending the definitions of various things, including covered employees. So in 2021, as part of the American Rescue Plan Act, or ARPA, Congress added to the definition of covered employee, which is effective in 2027. The proposed regulations that just came out provide guidance on these ARPA changes. Under current law, there are two categories of covered employees. One are the current tax year covered employees, and that has a specific definition: CEO, CFO, and 3 highest paid compensated employees for that tax year, which could be more than 5 persons, as well as a plus category of covered employees who were persons that were covered employees in any prior year from 2017 forward. These are all executive officers. ARPA added to the definition any employee who's among the 5 highest compensated employees for the taxable year, other than the individuals in Category 2 under current law. The proposed regulations are helpful because they provide definitions of employee and compensation, and it's important to note that those definitions are different than the definition of employee and compensation used under current law to determine the 2 categories of covered employee under current law. So companies will want to pay attention to that. They also apply current 162M regulation affiliated group rules for ARPA 5 purposes, and those include foreign corporations. The proposed regs include examples that address such various affiliated group scenarios, such as when there's more than one publicly held corporation in the affiliated group, where a foreign corporation is part of that group, and in third-party arrangements. And those are really important to pay attention to because they relate to payments from unrelated entities, PEOs, partnerships even, in relation to services by a person, whether or not they're treated as an employee of a publicly held corporation when that person is providing services to a publicly held corporation. So a few takeaways from the proposed regs. It's clear that Treasury and IRS are looking at avoidance of the application of 162M, particularly where companies are ignoring those expanded affiliated group rules of 162M or having third-party arrangements. This means looking at current 162M determinations, not just those that are going to impact ARPA 5 that's effective in future. Companies should begin to address the application of these proposed rules to prepare for that effective date in 2027. For more details, read the attached insight. Thanks for watching. This has been PwC's Tax Insights in Brief.